The Hershey Company, stock ticker HSY, is a dividend stock currently trading around $183.56, which is very close to its 52-week low of around $179 per share. Now, we can see its 52-week high is around $276 per share, so there is a big difference in the 52-week high and 52-week low, and in fact, over the past year, this stock has been hammered pretty hard, down around 29%, and year to date, down around 1.59%. So in this video, we're going to be looking at the dividend metrics for this company, looking at why it's dropped so much over the past year, and of course, seeing if we can find the intrinsic value by jumping into my stock valuation spreadsheet. And like always, if you'd like to be able to download any of my spreadsheets, then you can head over to tickerdata.com at the link in the description. So let's go ahead and jump into it. Now, like I mentioned, Hershey's is down over the past year around 28%. And when you put that in the perspective of the S&P 500, S&P 500 is up around 25%. So this company has way underperformed the market. So I want to touch on why that is. But first, let's look at the dividend metrics for this company. We'll come up here on my dividend breakdown tab, plug in HSY and hit enter. And you can see, thanks to the help of the ticker data add-on in Google Sheets, all this data will automatically load in. Now, the company has a pretty nice starting dividend yield sitting right at 3% at its current share price. And one of the things you'll notice is they have a nice history of increasing dividend payouts over the past decade, going from around $1.81 to 2023, they paid out $4.46. Now, this company did recently announce a dividend hike, and it was a good one. It was a 15% dividend hike they announced in early February, and we can see their dividend payout is now sitting at $5.48. So overall, from a dividend growth perspective, this company has been doing pretty well. We can see a 10-year dividend CAGR very solid at 10.4% and the 5-year at 12.88%. So from a dividend growth perspective, I'm very happy with how this company has done. And we can also see the payout ratios are in a healthy range, with payout ratio sitting at 47.75% and the free cash flow payout ratio sitting at 57.28%. And now if we look at the free cash flow CAGR, one of the things you have to keep in mind, dividends are paid out of free cash flow. So if free cash flow isn't growing, sooner or later, those dividend payments won't be able to grow either. Now we can see the 10-year free cash flow CAGR at about 6.36% and the 5-year at about 4%. Now, honestly, I'd like to see this be a little bit higher. Long term, they can't sustain these levels of dividend growth if the free cash flow isn't any higher. But if we come down here and look at the free cash flow versus dividends paid out chart, overall, I'm pretty happy with what I see. We can see free cash flow is easily covering those dividend payments, especially in the past 3 to 4 years. So for now, it looks like those high dividend payments can continue to happen, but ideally we do want to see a little more free cash flow growth moving forward. Now, when we look at the free cash flow payout ratio over time, I'm pretty happy with what I see. It looks like since around 2017, for the most part, this free cash flow payout ratio has stayed pretty much in the range of around 57 to around 42%. It climbed up a little bit higher in the past year, but again, overall, I'm pretty happy with the range this has stayed in. So from a dividend perspective, again, there's a lot I like about this company. We've seen good dividend growth, healthy payout ratios, a good history of dividend increases, and decent free cash flow growth. So what's the reason we've seen this company decline by 29% over the past year? Well, this is actually something I was reading about when I was digging into this company's Form 10K. You can learn so much about reading these forms, even though they are long and seem fairly boring. A Form 10K will give you an in-depth breakdown of the risk factors of any company. And after going through this document, I believe the most important risk we have to consider for Hershey's right now is increases in raw material and energy cost, along with availability of adequate supplies of raw materials, could affect future financial results. Now, essentially, what does this mean? Well, basically, Hershey uses many different commodities for their business, and one of the biggest one is cocoa products. Now, one of the problems with this is a commodity that could be subject to price volatility and changes in supply caused by numerous factors, including everything listed right here. And in fact, this has actually been the biggest problem for Hershey's over the past year. If we look at how the price of cocoa has changed over the past year, it's up over 309%. So this is a huge problem for Hershey right now. If we look at the past 3 years, it's up 378%, and over the past 5 years, 354%. So Hershey went through a long period of time where, for the most part, the price of cocoa was relatively stable, but we've seen it absolutely skyrocket over the past year. So what's the reason behind this? And the reason behind this is actually something that JP Morgan put out a report on just a few days ago. And basically, we can see the key takeaways are that cocoa prices are rising due to a global supply chain shortage, chronic underinvestment in cocoa farms, and investor speculation. Now, according to the same report, JP Morgan Research is projecting projecting that cocoa prices will come down slightly over the medium term, tracking around the $6,000 mark. But we have to keep in mind, if we go back and look at this chart, that's still not where it was 3 or 4 years ago. The 6K mark is around right here. So yes, it'd be about half as expensive as it is right now, but still quite a bit more expensive than it was 3 to 4 years ago. So this risk associated with commodities and the price is definitely something investors have to consider when considering Hershey's as a potential investment opportunity. Now, if we go ahead and jump over to the stock screener tab, let's go ahead and plug in HSY and hit enter. We can see again, all this data will automatically load in thanks to the help of the ticker data add-on in Google Sheets. But overall, just off a quick glance, the reason I like this stock screener is we can immediately see a lot of the metrics that are important to me as an investor, and for the most part, they look pretty solid. We can see revenue per share over the past decade has done a decent job of growing. I'd like to see a little more growth, but really it's not bad. Earnings per share has been very solid during this time, and free cash flow per share again. Dividends are paid out of free cash flow, and we also need free cash flow to reinvest back into the business. So this has been growing, so that's a good sign for the business. We can see the company has been buying back shares. In 2013, they had around 224 million shares outstanding. In 2023, it was 204. So again, bought back around 20 million shares over the past decade. Debt to assets, for the most part, is in a pretty healthy range. And one metric that is actually pretty impressive for this company is return on invested capital. Now, this is essentially a calculation used to determine how well a company allocates its capital to profitable projects on investments. So this is a really important metric for companies long term to remain profitable, and we can see in 2023, ROIC of 24.28%. That is honestly a lot better than I was expecting from this company, so that's definitely a bright point for this company. If we jump over to the profitability and income statement sheet, you can see I've already plugged in HSY. We've already touched on some of these things like earnings per share, but we can see gross profit ratio over the past decade has remained very stable, staying consistently close to around 45%, which is something I like to see. Now, the huge question is, what will this look like over the next year with the huge increase in cocoa prices? To me, that's one of the biggest threats to Hershey's. Now, before we jump into our valuation, the last thing that I want to touch on is Hershey's does have a new competitor in the market, and while a lot of people aren't taking them seriously as of right now, I think they could potentially cut into Hershey's market share in the very near future, and that is Mr. Beast Feastables bar. Obviously, this is a private company, so we don't have any data or information on what type of sales they're generating, but I think this is something to keep your eye on in the future. So with all this being said, Hershey's is right at its 52-week low. Is this a good price to consider buying the company at? The dividend metrics look good, overall historical data looks good, but they do have some risks. So let's go ahead and jump into our valuation spreadsheet. And you can see I've already plugged in HSY here, so the data has automatically loaded in. We can see a very, very low beta of just 0.33. So typically you see very low levels of volatility with this company. We go ahead and jump into our first valuation. We're going to look at Graham's valuation. And again, we're valuing the company based on the projected growth of the earnings of the company. One of the things we have to consider is the current yield on AAA corporate bonds. This is essentially an economic data point, and it's currently sitting at 5.27, which is much higher than around the 5-year average, which will drive down this valuation considerably. So even though they have decent estimated earnings per share for the next year and growth rate projection is decent, current market conditions are definitely driving down this valuation, leading to an intrinsic value of around $136.26. Now, our discounted cash flow analysis looks a little bit better. One of the things we'll notice is you can see here, we're projecting a growth rate to the future free cash flows of around 8.5%. So with a discount rate of 8%, you can see this is going to give us a discounted cash flow price per share of $184.64. And again, this is basically valuing the company based on how much free cash flow they're going to produce in the future. Now, the next valuation we're looking at is the multiples valuation. Now, I don't think this is a perfect valuation for Hershey's because we don't have a lot of great comparables. So I got as close as I could. And again, these are definitely not perfect comparables, but they do give us a little bit of an idea of how Hershey's is priced compared to how the market is valuing some other companies. We can see these companies' stock price divided by earnings per share gives us their price to earnings multiple. They have an average PE of around 18.15. Now, if we jump back over to our stock screener, one of the things we'll notice is Hershey's has a price to earnings of around 20.5, a little bit higher. So if we apply that same average PE to Hershey's, we would come to an intrinsic value of $165.01 per share. Now, the last valuation we're going to look at is our dividend discount model. Now, this one's going to be a little bit different than the other valuations. It values a company based on how much they pay out in dividends and how much that dividend is growing over time. And this is the one that makes Hershey look quite a bit different. We can see assuming a 6% dividend growth rate, which keep in mind, if we go back over to our dividend tab, we can see it has been easily attainable for them over the past decade. But assuming that 6% dividend growth rate and a discount rate of 8%, we come to a dividend discount model price per share of $290.44, quite a bit higher than the current trading price for this company. So if we jump over to the output tab, we can see all four valuations here together. Averaged together gives us an intrinsic value of $194.09 per share, a little bit above that current trading price. So with a 5% margin of safety, yes, it would be in your acceptable buy range. With a 10%, it no longer is, with an acceptable buy price of around $174.62 per share. And if we go ahead and apply a 20% margin of safety, acceptable buy price of around $155.22. So the big story right now when it comes to this valuation is, again, current yield on AAA corporate bonds definitely driving down this valuation quite a bit, and obviously the huge risk for this company is going to be those cocoa prices surging 354% over the past 5 years, and in the past year alone, 309%. So go ahead and let me know in the comments down below what you think of Hershey stock, if you plan on buying or selling. And like always, if you'd like to be able to download this spreadsheet and also get access to the ticker data add-on in Google Sheets, then you can head over to tickerdata.com at the link in the description down below. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.